I make 6 figures a month actively trading altcoins, and in this video I'm going to share the exact strategy I use. And no guys, it's not all Lambos and sitting in Dubai. The reality is trading effectively takes a lot of discipline and structure. Now, why should you listen to me? Well, you can see the last 6 months of my trading performance. In November, I delivered 260% spot returns. October, over 280%. December, 375%. You can see over 113% in January. I share every single one of my trades. You can see all the stop loss I hit. Look at this in January when grayscale was dumping. Bunch of stop losses. The reality is, trading is not about you being a genius, and hopefully when I break down this video, you'll understand that my strategy which I'm using is much more about me being diligent and disciplined than it is me being some super amazing, kind of future reader where I can tell exactly which altcoins are going to go up. And unfortunately, trading, particularly crypto trading, has gotten a really bad rap recently where people just want to talk about the fact that this is gambling. This is people who don't know what they're doing. And there are a lot of those. There are a lot of those people trading meme coins. But my idea of trading that consistently allows me to produce 6-figure winning months every single month on the trot is based on a strategy, a proven strategy, which I repeat time in and time out again. And it's not easy, but I'm going to walk you through the structure which I use. So we're going to start off here. At the first point, and this is just a very kind of informal video, I just want to talk to you as if I'm on FaceTime with you almost, kind of walking you through my strategy. The first step is you got to have a plan. Right? It sounds so boring when you hear somebody on Twitter say, oh, I just jumped in 1000x leverage on this Pepe coin. The reality is a pragmatic trader has a plan. They have a clear plan of how they are going to target this market. And what do we mean by having a plan, right? What do we mean when we say have a plan? Well, what is the strategy you're going to use? Right? Are you going to be a moving average strategy? Are you going to use moving average crossovers as your strategy? And there's plenty of strategy. You can use Fibonacci. You can use support or resistance, right? There are a lot of strategies. The key is, which one are you going to master? I mean, the analogy here I would use is you're going to be a footballer. Right? And you want to say, oh, I want to be a successful footballer. Yeah, but where are you going to play? Are you going to be a forward? Are you going to be a striker? Are you going to be a defender? What is your skill type going to be? Do you like dribbling? Do you like passing? What are your strengths and weaknesses? Are you a strong player? Are you an agile player? You need to find your strength. And it's the same with trading. Figure out where are you relatively stronger than the rest of the market. Because remember, you want to edge over the market. When you're trading, you're trying to make the difference in the inefficiencies in the market. So where the market doesn't understand certain patterns, where you have a slightly better understanding, that's where you're going to make profitable trades. So that's the first thing you want to define is what is your strategy. Also, part of your plan is going to be, what am I trading? Right? Many people, for example, will say, I'm trading Bitcoin. Okay, well, you do understand that Bitcoin moves within certain parameters, right? So if you're trading Bitcoin, can you realistically expect a 15-20% move on a day on Bitcoin? Difficult. So where, for example, I'm trading, I don't short the market, nor do I use any leverage. So my strategy is I use spot only, and I don't use leverage, right? And I don't short, so I long only as well. So spot only, long only, that is part of my strategy. That's part of me having a plan. Now, in order for me to use this plan, it doesn't make sense for me to trade Bitcoin, which is why I have to trade certain types of altcoins. I have to trade altcoins that are going to give me enough of a return. It makes no sense for me sat there trading an altcoin which only moves a couple of percent. I need an altcoin that from the position where I take the trade up until the point I take profits, I'm looking at least starting from 10% of my first take profit up to, let's say, 30% plus on a trade. Right? So I need an altcoin which probably has the potential of moving more than that because I want to capture my percentage. I'm not going to capture the perfect move. I'm going to get a little bit in between. This is going to be my profit. So really, I'm looking for 40 to 50% moving altcoins. So by definition, I need to find an asset, an altcoin, that has the ability to move this much. And it can move for various different reasons. There could be good hype behind the altcoin. They could have launched a new update. They could just be forming a really important technical analysis pattern. But I need to be able to see this kind of a potential for me to take the trade. Okay, so that's very important. I need to have my plan locked and loaded. Once you've got your plan locked and loaded, it's time to move on to point 2, which is going to be making sure that you've got your risk management intact. Now, when I was trading an investment bank, remember, I learned trading traditional assets, right? Foreign exchange and equities. I only then started applying that to crypto later on. So when I was in an investment bank, the best trader on the floor, who eventually got headhunted by a major hedge fund and started building his career out in a hedge fund, he wasn't that good. What do I mean by that? Well, nowadays, if you go online, somebody goes, oh, what is a good trader? Well, they're going to say, yeah, but a good trader is one that never gets anything wrong. Anytime he says he's taking a trade, that altcoin goes to the moon and he gets it right every single time. Now, what that average layperson is referring to is what is known as win percentage. Right? Win percentage is of the number of trades I take, what percentage do I win? So for example, if I take 10 trades for easy numbers and 6 go and hit my take profit, I am operating at a 60% win rate. Okay? Very, very interesting. Now, his win percentage wasn't that great. I mean, it was even less than 50% at times. And yet he was the most profitable trader to this day that I've ever traded alongside. And why was he so profitable? It was because of his risk management. Risk management, the boring buzzword which nobody actually wants to comprehend and understand. And yet for me, this is the crux of trading. If you can spend some time actually mastering this piece, if you're a youngster or even slightly old and sitting here wanting to pursue a career in trading, this is the bit you need to figure out. It's not about you being a genius on the win rate. It's not about this. It's about mastering this piece here. Let me explain. Let's say you take a trade, and in that trade, how much you're risking to the upside versus the downside is known as your risk to reward. Very important. The risk to reward, also known as the R multiple, right? And people refer to it in many different ways. Now, if you're operating to a 2-to-1 risk to reward, that means that I want to make at least 2 times more than I can possibly lose on a single trade. Hang on a minute, what do I mean? Okay, let's explain. So let's say this is the level I'm entering my trade. And let's say I apply my stop loss. This is the level I apply my stop loss. Now this distance here is how much I'm losing. Right? This distance here is how much I'm losing. Let's say I'm willing to lose 10% to the downside. I'm using easy numbers here, guys. Well, therefore, my take profit level needs to be set such that if I want to adhere by this 2-to-1 rule, I'm making minimum 20% to the upside. Okay, so the distance has to be 2 times. Now, why is this important? Think about it. So now we go ahead and we take 3 trades in a row. Okay, so we take trade 1, we take trade 2, we take trade 3. And let's say I did a great job on trade 1. Straight off the bat, I win. And then on the next 2 trades, I lose, and lose. What is my return? Well, on the first one, what did I get? I got plus 20%. On the next one, I got minus 10. And the next one, minus 10. So overall, what did I get? I break even. 0%. Right? So, but think about it, guys. Think about what's just happened there. I've taken 3 trades. 3 trades. 2 I lost. 1 I won. And yet I'm still break even. This, in a nutshell, is what I'm deeming as risk management. This is very important. In other words, my risk to reward allowed it so that even though I got 2 trades out of 3 wrong, so my win percentage was 1 out of 3 trades. Guys, that's 30%. That's like worse than guessing, right? If you were to guess if a trade's going to go up and down, your expected result is 50%. You should get it right half the time, even if you're just guessing. If you had no experience, if you knew nothing about the market, you did no research, your pattern didn't help you, at least you have a 50% chance of guessing if it goes up or right down. Here, I got a 30% win percentage, which is awful. Sad face, and yet I still break even. And this is why when I shared the results with you over the last 6 months, some of those months were horrible. I hit a lot of stop losses, 6 stop losses, 7 stop losses. It doesn't matter, because the way I've stacked up my risk to reward is that as long as I get a few right, as long as I can keep my win percentage roughly okay, I'm still going to do well. I'm still going to at least have a break-even month, but as you've seen, I've not had even a break-even month. I made at least 100% profit in every single month in the last 6 months. And that, again, is not because I'm a genius picking perfect trades. It's not because my win percentage is always amazing. It's because I can manage the risk. And what that allows me to do is that even if the month is bad, I'm doing all right. And if the month is good and my win percentage is really strong that month, if I really start hitting 60% win percentage, then I'm printing, because then I'm getting more wins than I've got losses, and this starts to really skew in our favor. So really important that once you've got your plan in place, you've got a strategy, a proven strategy that gives you an edge in the market, you then focus on the next step, which is getting your risk management in place. Okay, so hopefully that makes sense. And so the next natural question is, okay, what happens next, right? Like, how do I actively do that? Let's go into the charts and see how we do that. Okay, guys, so now we're in the chart and you can see an example of a trade I took here. And this trade delivered 38% returns here. Nice move. So you can see on the hourly chart here, it was in a descending channel. And this is one of my favorite strategies. Going back to our first point, we have a plan. Now, it's not that your plan is any different to my plan or my plan is the one you have to use. No, it's just this plan is the one I'm experiencing in. It's the one where I can spot patterns easily. So I will set up all my altcoins in a watch list on the right hand side, and I will start monitoring them. I'll start charting the patterns. I'll look at the RSI. I'll look at all the different technical patterns. And when I see that we're close to a pattern, so for example here, when I saw this bounce from the 4-hourly demand zone and start heading to attempt to break out of this descending triangle, I'm now getting ready to place a trade. I wait for the retest and we enter this trade on the break. And now you start entering the trade, right? So when you're entering this trade here within the range, I'm looking for the first take profit. I set it at the first pivot point. I then set my second take profit at the next natural pivot point, and my third pivot point all the way at the top here. So I've got my 3 take profits. And of course, stop loss to the downside where there was some support here. And so you can see exactly how I've done so. I've made sure my risk to reward, the amount I can gain here, 38% to the upside, is much better than I'm risking to the downside. I'm only risking this distance here to the downside. And that is how I practically then enter my trades. Now, there's another factor you need to take into account, and that is allocation. Now, this is another mistake I see a lot of novices making when they're trading. We spoke about risk management. We spoke about win ratios. We spoke about making sure you're stacking the cards in your favor. But it's also about allocation. I'll give you an example. I can give you the exact next 5 trades I'm taking. I give you the exact next 5 trades I'm taking, and you can fundamentally get different results trading them than I can. Why is that? It's based on allocation, right? If I share trades with you, if I share 5 trades with you, let's go T1, T2, T3, T4, T5, and I equally allocate $100 to each trade. Right? So I've done the same there, I've done the same there, done the same there, done the same there. $100 in each trade. So altogether, I'm allocated $500. But you go, hang on a second, I'm going to do it differently. I'm going to go $250 on this one. I'm going to go $250 on this one. And then I'm going to go nothing on that one. I'm going to skip that one. I'm going to skip that one. You're going to get fundamentally different results. You've basically taken a strategy, which I've defined over this period of time across 5 trades, and you've turned it into a gambling mission, where you've gone, hang on, I want to get more results, so I want to put more money into a single trade because $100 is not enough for me. I want to put $250 on. And so what you've done is you've said, I really think this is going to be a winner. I'm relying on this being a winner, and I'm relying on this being a winner. And so if those two ended up being the stop losses, you've lost heavily on those, and yet these 3 could have easily been the ones which were the winners. In fact, that one could be a stop loss as well. These 2 could be winners, and this is where I'm going to be printing. right? And remember, because of my risk to reward, these winners more than account for the losers. It accounts for that, it accounts for that, and it accounts for that. So I'm winning, whereas this person just hit 2 stop losses and they're crying home. So it's really important that you understand the importance of diversifying and allocating your funds across a handful of trades, right? When you have a strategy which you're trading, unless you have a reason, which rarely you will, for why you're putting double the amount on one trade versus the other trade, I like to keep them equal, because all my theses, for example, the one I shared with you of the breakout of the descending channel, they're generally the same. They're generally about the same thesis, and therefore I want to put the same amount in each trade to give me that risk to return. The other thing you need to be very wary about is making sure you don't risk more than you're willing to lose. Right? You don't want to risk more than you're willing to lose. You don't want to be in a position where one stop loss wrecks you. You want to make sure that you're in a position that even if your open trades, let's say you've got 5 open trades, were all to go down the pan, all were to hit stop losses, you're still okay. So you want to do the calculus to make sure that even if all my trades open were to hit stop losses, I'm okay. It's still only a certain percentage of my trading account, whether that's 5%, 6%, 10%, depending on what you're comfortable, right? This is your preference. Some people are comfortable easily losing 10% of their portfolio. They don't mind. For others, trading with a bigger portfolio, losing 5% of your portfolio is a bit of a concern, right? So you need to adjust that based on the size you're trading with and based on your risk appetite as well. But very important that you figure out what is your allocation. Now, the other thing I want to talk about is something known as meddling, right? What do I mean by meddling? Well, meddling is when people think they can suddenly start changing around the trades once they're open. And really, this is a point of psychology. I'm going to place this down as psychology, because what a good trader does versus an inexperienced trader is the good trader goes, I had a plan at the beginning and I'm going to stick to that plan, right? So the plan we set in point 1, I'm going to stick to it. Whereas a novice trader goes, hang on, I had this plan, but I'm getting really close to the stop loss. Why didn't I just move my stop loss slightly? Why don't I move my stop loss just down a couple more percent, right? Just to give it a bit more room because I think the altcoin is going to bounce. Or equally, the altcoin is doing so well to the upside and you're like, oh, I've hit my take profit, but I don't want to take profit. I think it's going to go up some more. Like everybody on Twitter and everybody else is telling me this is going to rock it. I want to stay in it, right? And you end up getting caught up in FOMO. So really important that you're able to detach from emotions, right? You want to take your emotions out of the equation. Trading is a game for the stoic. You need to be stoic, guys. You need to have a plan and you need to stick to it, right? I've never met a good emotional trader. Right? Fundamentally, you need to be numb to the market. You have a plan and it doesn't matter, right? Once you've set that plan and you've set the trades, just like I shared with you before, it doesn't matter. It doesn't matter because the risk to reward is in my favor. If I hit the stop losses, I don't care. I literally don't care because it's accounted for in my maths, in my model. So I don't care. Do you see what I'm saying? Like the psychology needs to be so on point here because otherwise you go round in circles second guessing yourself, which is why I don't care if I hit stop loss. I don't care. It's budgeted, right? It's like running a business and being really nervous that you have to pay your employees at the end of the month. Like, or I'll give you another analogy. It's like being in boxing and being really nervous that someone's going to punch you. You're not going to last long as a professional boxer if you're scared that you have to take a punch. It's part of the game. If you're trading and you don't want to hit a stop loss, you need to be in some sort of pump or dump group where they're promising you that you're always going to win. A real trader is always hitting stop losses. Like I spoke to you about my mentor at the investment bank, he was always hitting stop losses. It was part of the game. It actually doesn't matter. It just matters that you're in the game long enough that you hit winners, and those winners are going to make you more than the losers. Fundamentally, that is the equation. So very important, you do not meddle, right? So you don't want to meddle. You don't want to change stop losses or take profits. And one way which you can, help yourself improve on this is journaling, right? And this is going to come onto my third and my kind of final point here, which is you need to have a feedback loop. This is the boringest part. This is the boringest part of trading, but I force myself to do it, right? You can also call it journaling. Journal your trades. So what do I mean by that? After every single trade I take, guys, I journal what went well and what didn't go well, right? I'll have a very simple spreadsheet. If you guys want access to the spreadsheet, comment below spreadsheet and I can get a link set up for you guys to go and download that spreadsheet. But in other words, it's just a basic journal. I say, okay, what trade did I take? Did I win? Did I lose? What was my strategy? And sometimes you realize you didn't even have a strategy, right? Which is where you go, okay, I need to tell myself off here, I didn't have a strategy. And then you even put here, did I meddle? Right? Did I meddle? Did I change my stop loss or take profit? Did I intervene with the trade? Did I risk the right amount? Was my risk to reward okay? And you journal it. And what you'll find over time, particularly when you're new, this would happen to me a lot, is I would have a plan. I'd write down my plan, but as soon as real money was in the trade, I'd go against everything I wrote down. I would mess up my risk to reward, right? Because I was so desperate to jump into the trade that I changed my entry point. And then when the price was going down, I was so adamant that I didn't want it to touch stop loss, so I moved my stop loss. These are all big no-nos. Or I give you another example. I was so desperate to jump in onto a coin because maybe I saw something on Twitter or I saw some update or I heard something from their CEO and I knew they were going to do something, but I had no pattern. It wasn't my moving average crossover. It wasn't in a descending channel. It wasn't bouncing from support, and so I had no technical thesis to trade it. I was letting my emotions and FOMO get the better of me. So this boring piece of exercise is one of the most important things you can do if you're serious about trading. If you're serious about trading, because just like any other profession, you're not gonna make it in trading without this kind of an approach to trading. You're not. You have to treat it like a proper business. Just like a business person sits there and processes their whole business. Just like a footballer has a regimented training routine and a strength and conditioning routine and a strict diet. You as a trader need to be able to do this. If you don't, you're not taking it seriously. You're just treating it like gambling, which is all right. If you want to treat it as gambling, you do you, but you can't class yourself as a professional trader. So if you want to take trading seriously, if you want it to be part of your life going forward, if you actually want to be able to, generate the real serious money, 6 figures a month consistently, you need to be able to follow the steps here. You need to have a plan. You need to make sure you got sound risk management, work on your win ratios, make sure you're doing feedback and journaling. And then the last tip I'm going to leave you with as a bonus is macro cycles, right? Macro cycles. And this is what's really going to stand you out from your average trader. Let's say you mastered all the tips I've just shared with you. This is what's going to put you in the top percent of traders. So if you take the average trader, what they're very good at doing is, let's say, technical analysis. We'll call that TA. So similar to what we were speaking about earlier, they have mastered the Bollinger Band. Maybe they've mastered certain chart patterns or candlesticks. They've got a really good technical analysis foundation, and that's what they use to trade off of. Now, if you can master the next piece, it's going to level you up. Fundamental analysis. Right? If you can take technical analysis and layer on top of it some understanding of what you're trading, you're automatically going to become a better trader. I'll give you an example. If somebody is doing technical analysis on a coin and then you look at that technical analysis, go, oh, that looks great. But did you know the CEO of that project's about to leave next week? Yeah, you don't want to be taking that trade, do you? Exactly. So you want to be able to ladder in some basic fundamental analysis on top of your technical analysis. But then there's one more, even more important overarching point, and that is your macroeconomics. Your macroeconomics is what's going to stand you apart. And this is understanding where the market's going. And if you follow a lot of the content on this channel, this stuff is covered. This stuff is covered. But I want to spend a lot of time talking about this because this is what most people will not teach you. They will not tell you that, oh, look, you want to trade altcoins. You want to trade Solana. You want to trade Cardano. You want to trade all these things. But do you know what's going on with Jerome Powell? Right? Do you know what's going on with interest rates? Do you know what's going on with the dollar index? Do you know what's going on with the oil price? Do you know what's going on with inflation? Do you know what's going on with, the ISM manufacturing and the job figures? Do you know how all of these things will affect your trades? Because you could be great at technical analysis. You could have the perfect pattern. You could even have done your fundamental analysis. But if Jerome Powell's about to give a macroeconomic update, if inflation is about to release a new CPI data and you're in a long trade, you're going to get wrecked. Right? So this is the tip that's going to make you stand out from the average trader. Do some TA, do some fundamental analysis, layer on your macroeconomics, and you will be a force to be reckoned with in the trading space. So there you have it, guys. That is the structure I use. See you in the next one.